This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have Mish Shedlock of Sitka Pacific Capital and the Global Economic Analysis Blogspot.com joining us this morning from Chicago. Welcome, Mish.
Hey, a pleasure to be back on the show.
Every month we have completely different things to talk about. And I want to make sure we have lots of time here. Can we just talk right now, because it's just breaking news, about the FOMC meetings results, what Yellen announced, and most importantly, what are your views on what's going on here?
I thought it was a coin toss coming in. I really did. The market only had an expectation something like 25 or 30% or something they would hike. But that expectation was based on the fact that they were going to hike a quarter. I thought that when they hiked, they were going to hike an eighth. Well, they didn't hike at all. You know, it's the carrot and the stick. I've got this cartoon envision in my mind, Gordon, of Janet of a mule saying the economy, of Janet Yellen holding this carrot out in front of the mule, saying better times are ahead. You know, with the mule about ready to plunge off the side of a cliff. That's the image in my head here, because I think the Fed's going to delay so long now, they might not even get in a hike. So it's all absurd to actually think that an eighth of a hike or a quarter of a point hike is actually going to do anything other than perhaps put an end to the damage they've already done. And John Hussman had a great article on that the other day, where, and I've said the same things, and so have you, that the Fed has blown this enormous asset bubble. And then as soon as they hike, if everything goes to hell, it's not going to be because the Fed hiked. It's going to be because of they didn't hike, because they've blown this asset bubble. They've encouraged this asset bubble, my gosh, since 2009, March of 2009.
You know, we're looking around the world, and we're seeing a slowdown that is worse in my mind than 2008. World trade, shipping, everything else. And if she was to increase the rates, the U.S. dollar would have strengthened even more, and which is just killing the emerging markets, etc. So I thought she'd boxed herself in if she was in any way concerned about the global economy, not just the U.S. economy. And I'm noticing here the U.S. dollar is falling as we talk. Of course, the market went up, and now it's neutral from the results. So she may have achieved what she wanted. That is a weakening of the U.S. dollar.
Well, maybe, but the dollar might even, weaken a little further, regardless of what they do. It might have even actually weakened if they'd hiked. For instance, had the Fed come out and done what I expected if they hiked, which they didn't, which was raised by an eighth of a point, I think the dollar would have sold off on that as well. But I mapped out, and I'm going to do it again. It'll be a nice exercise at the end of the day. The market expectations for these hikes, and it's real tiny and real slow. It's like an eighth of a point every other or every third meeting, and it'll be interesting to see what the Fed Fund futures did, after today. My guess is it's going to stretch these hikes way out even further, on the basis of something, that Yellen said in the press conference afterwards about the participants' expectations for interest rates being longer. She came flat out and said it. I didn't hear the exact question. The questions to me were irritating, though, Gordon. No one asked a pointed question. No one asked about. Actually, towards the end, someone did ask about income inequality. But they have to tiptoe around these things with the way they ask these things of the Fed. So the whole thing was a joke. Actually, it seemed like to me that the Fed did little more than take the statement they issued last month and issue it again this month. And how long? It's been well over a year now that the Fed has been trying to cajole the market into expecting a hike. But every time they do, the data gets weaker and weaker. It was funny. The Philadelphia Fed came out today, and the expectations were for a bounce in the Philadelphia Fed. It plunged to its only negative reading, in the last couple of years. And Bloomberg issued a statement, well, maybe it seems like people are right and manufacturing is weakening in the Northeast. And that's not quite it. They phrased it even screwier than that. And I said, the Northeast? The Dallas Fed is plunged in negative territory for months. So is the Kansas City Fed on account of oil. The Richmond Fed laid a big goose egg last month. And I remember the statement now. Bloomberg said, well, there's something here going on, at least in the Northeast, that we don't understand it. Well, my God, where have they been? Manufacturing's been a disaster. One of the few things keeping this economy together has actually been auto sales, and housing's been sort of mediocre, but mediocre is what one would expect when one's talking about
retail sales are painting a bad
Gordon.
picture. Industrial production's painting a bad picture. You've written about all of these. I don't know what they're missing. And you made a really good point about the auto sales. They've been relatively strong, but there's a black hole there, Mish, in my mind, in that 1/3 of all auto sales today are leased, 3-year leases, and the other 2/3 that are being bought are out 67 to 80 months. And so the return of these cars, you can see them on the wholesale auctions, or as far as the eye can see. And what that means is residual values. Remember when the housing market collapsed, it was the residual value of the house. They're plummeted. They're down 6 to 7% according to Edmunds already. And that's all in the shadow banking. That's all in the shadow banking.
When there's any kind of tightening, in the subprime auto sector, I think these sales are going to collapse. And then some of these things are going overseas too. And we've already seen exports weakening. And, for the first time, one never knows. I mean, every month I keep expecting, I keep wondering, is this the top of the auto market? And every time we see a little dip like this, there's a strong rebound last month or the next month. So we'll see if that happens again. But market, does its global reports and noticed a global slowing across the board in auto manufacturing. That's the first time I've seen that, but I've never really watched global auto sales that much. So I need to get a handle whether this is, now something spreading globally.
The auto sales are so important to all of the countries. Every country's in some way an auto exporter, and all the commodities that support it. So it's something that I think is a little bit more serious, and everybody's paying attention. Paying attention to, my personal opinion.
Yeah, on the deflation front, the Philadelphia Fed came out today, and the prices received the manufacturers are getting for their manufactured goods. Down, down, down. The only thing that's reason why this isn't an enormous problem is the prices they have to pay, primarily for oil, have also been falling. So the two go to sync. And that actually lays into some more of the ridiculousness of the Fed's 2% inflation model, because no one's been damaged by this. What they're going to be damaged by, though, is the asset bubble when the asset bubble bursts. That's what the biz has said, and that's what if I was there, if I got to ask the Fed a question, it would have been a really pointed one. How come the biz sees it this way? How come common sense sees it this way? And how come the Fed doesn't?
Could almost be assured
my last question
of that.
I'd never be invited back.
Yeah, and it is an issue. If assets collapse or fall further, the amount of pyramiding of the assets that are used for collateral, call them margin calls if you want, but in the bond market specifically, it would be absolutely devastating without question. Mish, I want to change gears if I could, so we don't run out of time. This ongoing saga of Illinois and Chicago. You've written a couple articles in there. One of them was on dentists, not government not paying dentists. Can you update us on what's going on in your area?
Well, the Illinois has no budget. They tried to pass one in May against the Constitution. The Constitution says we have to have a balanced budget. Actually, most states are like that. I think maybe only one or two don't allow for it. But they play games. They borrow money from the future. They overestimate tax revenue, and then they just push off the deficits, into next year. This year, they didn't even the legislature didn't even attempt to pass a balanced budget. It passed one that was like $8 billion out of whack, and they sent it on to Ronner, and he said, "No, I'm not going to sign this." Like they didn't even give him a semblance. They didn't even pretend that we had one. So Illinois, as if it doesn't have a budget, constitutionally can't pay the bills. But last year, lo and behold, almost as if they knew this was going to happen, the legislatures passed a carve-out for themselves. No matter what happened, the legislatures got paid. So they got paid whether there was a budget or not. There's no pressure on them now to produce a budget because they get paid, okay? So the Ronner was probably going to be in deep, hot water right about now, actually mid-last month, because they would have been unable to pay the public schools. They would have been unable to pay the primary and secondary schools. So but he worked out a deal with Mike Madigan, the Speaker of the House, Mike Madigan, who said, okay, they did a carve out for the school budget as well. So the schools actually started on time. Now, imagine if Illinois schools did not start when they were supposed to this year, there would be enormous pressure on Ronner, on the legislature, on everyone to come up with some sort of deal to get the kids back in school. But for some reason, Madigan went along with this. And now the pressure is totally on the Illinois legislature. Madigan says, nope, I'm not going to talk about any tax hikes unless we get property tax capped, unless we do some business reforms. I would like to see him do right to work and prevailing wage. That's probably not in the picture. What Ronner wants is a restructuring of what's the word I'm looking for here? Of the disabled. When someone's disabled and they go on unemployment insurance, Illinois has horrendous policies, one of the worst states in the nation for businesses about what happens to workers and when they're laid off, when something happens to them, and he's holding out to get these things fixed. And my gosh, Madigan doesn't even want to go along with this. So, it's the old standoff, two people facing each other, each waiting for the other to blink. But I think Ronner has the upper hand here because eventually more and more things are going to be unpaid. They stopped paying dentists, which is what you asked me about. But next up on the line is medical bills. And guess who gets hit by that? The legislature won't get their own medical bills paid. And so I'm hoping that's the catalyst, but you never know. I would like to see Ronner hold out for a lot of things. We need to end collective bargaining of public unions. We need to end prevailing wages. We need right to work. We need to end defined benefit pension plans for all new hires. A whole slew of things. There's at least 8 things that need to be done. And I'd like to see Ronner at least hold out for some combination of 4 of them, not just the 2 he mentioned.
Mish, is there anything in all of your writings that we haven't talked about that you really would like to mention or bring up here?
Well, there's just a lot happening globally, and the big story, I think, is China, the slowdown in China. Virtually no one believes, and I've been talking about this for years. There's no way China's growth is 7%. Economists have finally, wised up to this picture, and now think that China's growing 5%. I think China's growing 3%, maybe. And that's probably a hard landing for China. Yet they've fallen back, and they've actually had to take steps to prop up the yuan. The other story going on in China is one of capital flight and the plunging stock market. Down, 40% from its high. The Chinese government central bank came in, issued statements, banned any talk of bubble. They actually rounded up a few scapegoats, paraded them in front of the media, and a guy apologized for saying something, insensitive and causing a market exasperation. Meanwhile, the central planners refused to. They said people can't sell their shares. Well, think about that for a second. If you can't sell your shares, how is anyone going to be able to buy them? Because, apparently you can buy them only, but you can't sell them. These guys don't even know how markets work. Because in the equity markets, for every buyer, there's a seller. So how do you accumulate shares? So what they're saying, I guess, is the big pension plans can't sell. These other people can't sell. That means the pension plans have to buy more. And who are they going to buy them from? They're going to buy them from individual investors. So putting all this risk now, even more risk on the pension plans, who may really not want to be buying stocks at all. So they've exasperated. They've brought on all of this stuff by not knowing how markets work. And of course, it's idiotic that these guys actually think that they can push all these buttons and cause all these things to happen. Everyone knocked Russia when Russia had its economic models, when it controlled the amount of steel output, when it controlled all of this and that. It didn't work for Russia. It's not going to work for China. It's never worked in history. Yet some people think that that central banks know how to set the rate of interest far more harder to do than were I to, and I think I said this to you the last time I was on, globally set the price of orange juice. I think it would be easier to do the latter. We would at least have data coming in from how many oranges are being produced and what perhaps the price ought to be. But these central bankers all have goals, and it's all to weaken their own currencies. And we're all in this competitive currency debasement thing. And the idea that everyone can push all these levers and get what they want when other central banks are acting in a manner that's counterproductive to what each country wants, it's clearly nonsensical. But that's what people believe. And these are the questions that came out of the Fed conference today.
Mish, I'm sorry. I really apologize, but we're long past our hard line. I've got a break here. Thank you very much, and we'll catch you again next month.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.